President Trump is pushing a higher tax rate for top earners while Congress continues to debate raising the state and local cap on SALT. Join us now to talk about this. Budget Lab President Natasha Sarin. She's also a Yale professor and the Heritage Foundation's Richard Stern. Natasha, it's good to see you. I'm going to talk about the latest about raising tax. I don't think you've seen a tax increase you don't like. So I'm going to start with basically, right? I mean, sort of. And I'm not even sure Richard is against this one. You're probably not thrilled with raising the higher rate, but if small businesses were excluded, and if it was $2.5 million and $5 million for joint couples, could you go along with that, Richard?
It's still better, but absolutely not. Look, this is the tax we should not increase. I want to see as much progressive tax cuts as possible in this bill, and I want to see them reduce deficits by cutting the wasteful spending, getting rid of the fraud and the overreach of the government. And
you divide the two parties, Natasha, and it comes really down to that, whether we cut spending or whether we raise revenue. If you were, let's say you could write the tax bill, Natasha, what would you do right now to try to raise more revenue?
Well, so a bit of what I would do is actually responsive, I think, to Richard's point, which is the challenge that's before members of Congress right now as they're looking at this bill is a pretty simple math issue, which is that we're talking about somewhere in the range of $8 to $10 trillion of tax cuts. Plus, if you try to think about SALT, that's about another $1 trillion of tax cuts. And there really just isn't any way to come up with revenue or spending cuts that is going to get you anywhere close to that number. And even if you're looking at this tax on high earners, which I would be supportive of, but Josh Hawley said he's supportive of it, and maybe there's like one or two members of the caucus who are as well. So these are hard tax cuts, tax increases to get done. That's raising you something like maybe $400 billion over the course of the decade. So we're not getting anywhere close to the type of revenue increases we need. And I frankly don't think that we can afford trillions of dollars of deficit finance tax cuts. So you're in a bit of a challenge from a legislative perspective.
Yeah, it's as plain as, all you got to do is look at it, Richard, and you come to that conclusion. Would you just say, but Natasha, we're going to get so much growth from these cuts that it's the CBO, they can't actually know exactly what net it's going to be? Would you fall back? It's kind of like fuzzy math. Would you? Let me ask you this: would you have another end to the cuts? Could they expire in 5 years like they did last time to make it more palatable? Is that on the table?
So I think you can read my mind a little bit. I would say that that's part of it for sure. Is that we're going to have deregulation. A lot of the tax cuts themselves, because they take the boot off of entrepreneurs and investors, will get you growth, and that will cover some of the deficits. I do agree it's important to keep deficits as low as possible. They are another form of tax. But actually, to your point about expiration, what I would say is the vast majority of the expiring bill is actually balanced on a 10-year basis and balanced past the 10-year mark. That part of the bill, which is, all the stuff about the deductions, both standard and itemized, child tax credit, 199 Cap A for small businesses, all the expensing provisions for both large and small businesses, you could make all those permanent. You could make those all permanent today with essentially no deficits. And then as Congress cuts spending, as we're confident we're going to get revenues from deregulation and other pro-growth elements, use those to extend the rest of the bill for as many years as possible. The last thing I would say is it's only $10 trillion. It's only that huge number. If you go all the way out to Trump's fullest talking points on some of the new tax cuts he's thrown out the door. But the truth is, the variants that he's worked on with Congress are probably only a few $100 billion, not a few $1 trillion, because they're smaller than a lot of the memeing that's going on. So all in, we probably could get 6, 7, or even 8 years of temporary tax cuts in that space and really make the vast majority of the bill just permanent overnight with the spending cuts Congress is thinking.
Let me just ask Richard one more thing. I'll get back to you, Natasha. Entrepreneurs, if they excluded small businesses and it went to $2.5 million is where the top rate would begin, $5 million for couples. You really think that different? I mean, those are pretty high net worth or high income individuals, and you exclude small businesses. You think you could actually see the damage being done to entrepreneurship from doing that? Richard, why?
I do think so. Yeah, I mean, so all these things have indirect costs that are hard to pin down, but they're there. So even if it's not a business owner you're taxing, they're an investor. They make money available to mom and pop restaurants around the corner. So if you tax high net worth earners, even if their income is passive, they don't feel it. If they've got enough money, it doesn't change their lifestyle. It just restricts capital, frankly, to new entrepreneurs, to startups, to people who are more in the $100,000 income range, who own one or two restaurants. So that's actually why I'm so passionate about keeping taxes low across the board. It's to make sure capital gets to people who need it to start new businesses.
Natasha, you'd probably like to go well below the $2.5 million, I guess. What other? So specifically, where would you raise taxes? What would you do to generate a lot more revenue, Natasha?
So one thing I just want to be clear about in Richard's response to you, and then I'll tell you about some tax increases, is this idea that somehow extending the expiring provisions of the Tax Cuts and Jobs Act is something you can do without having an impact on the deficit. That's just frankly not the case. If you look at every congressional scorekeeper who has estimated the impact of the TCJ extension, it's somewhere in the range of a $4 trillion impact. I realize there's a lot of conversations happening about baselines and what baseline to use, but there's no real way to wish away the fact that even just the extension without any of these new tax changes that we're talking about is a $4 trillion cost that we need to come up with a way to pay for unless you want to do a massive deficit increase. And those growth impacts definitely do exist, but they're quite small relative to that price tag. That's what the empirical evidence tells you. So you have a ways to go with respect to trying to come up with revenue. I do think there are some razors that should be on the table and part of the conversation. Obviously, I'm supportive of these ideas of particularly for high earners, allowing the Tax Cut and Jobs Act rate cuts to expire or even go to a higher rate. I'm also very supportive of something I've gotten to talk to you all about, and I know Andrew is interested in it as well with respect to trying to get rid of things like the carried interest loophole, where there actually is real money there, and it's not just real money, it's also incredibly distortionary and, as a matter of fairness, just doesn't make a lot of sense. There's also a lot of scope, I think, with respect to trying to undo some of what has been done by this administration over the course of the last few weeks, with trying to make it easier for the Internal Revenue Service to be able to collect a lot of the taxes that are owed. Right now, we're missing out on about $700 billion annually, and that's in taxes that are owed under the tax code today, not new taxes that you have to collect.